Hello everyone, welcome back to Economic Edge, where we simplify complex economic and banking concepts for you. Today's topic is market risk in banks. What is market risk? Market risk refers to the potential loss a bank may suffer due to changes in market conditions. These are the risks that come from the external environment, changes in interest rates, currency exchange rates, equity prices, or commodity prices. If the market moves unfavorably, the value of the bank's assets or trading positions can decline, leading to losses. For example, if a bank holds government bonds and the interest rates suddenly rise, the bond prices fall. This decrease in bond value is a market risk. How are banks exposed to market risk? Banks are exposed to market risk primarily through their trading book. This is a segment of the bank's portfolio that includes positions meant for short-term trading or market making. In simple terms, banks buy and sell various instruments to earn profits from price fluctuations. The trading book typically includes debt securities like bonds or loans, equity instruments such as shares, foreign exchange or currency positions, derivative products like futures and options. Note, Indian banks are not allowed to trade in commodities. These positions are actively managed and valued frequently because their prices change daily with market movement. What is the purpose of holding proprietary positions? Proprietary positions are those where the bank invests its own money, not on behalf of clients, to earn profits. The aim is to benefit from price movements. For instance, buying shares anticipating their value will rise and then selling them at a higher price. However, proprietary positions carry significant exposure to market volatility. The more unpredictable the market, the higher the risk. Banks also use these positions to hedge against other exposures, but it still involves calculated risk. What kinds of risks exist in the trading book? There are mainly three types of risks. 1. Market risk. This arises from unfavorable price movements in the market. 2. Liquidity risk. This comes in two forms. Asset liquidity risk, when the bank cannot sell an asset quickly without reducing its price. Market liquidity risk, when the market itself lacks enough participants to buy or sell assets without major price impact. 3. Credit and counterparty risk. This refers to the chance that the other party in a transaction may default. All these risks make the trading book very sensitive and high stakes. How does market risk affect profit or loss in a bank? It's all about the change in market value. The bank marks its positions to market, meaning, it records the value based on current market prices. If the value of assets falls between 2 points in time, the bank incurs a loss. So, profit or loss from market risk equals market value at end, market value at beginning. This applies daily for active trading desks. It's why market risk is considered dynamic and requires constant monitoring. What is the liquidation period and why does it matter? The liquidation period is the time it takes to close or sell a trading position. The longer it takes to exit, the more the position is exposed to price volatility, which increases risk. For example, a position in foreign exchange markets can usually be liquidated within 1 day. But a complex or exotic derivative might take days or even weeks to unwind. The longer you're exposed, the more vulnerable you are to adverse movements in market prices. Let's summarize what we've learned. Market risk is the risk of loss due to changes in market conditions like interest rates, currency prices, or equity values. Banks are exposed to it through their trading book, which contains positions meant for short-term gains. Proprietary positions aim to earn profits but come with high volatility. Risks in the trading book include market risk, liquidity risk, and counterparty risk. Losses due to market risk are calculated as the decline in value over time. The liquidation period affects how easily positions can be closed. Longer periods mean higher potential risk. Closing remarks. That's all for today's session.